When offers and promises are too good to be true, it's often a sign to be suspicious. Unscrupulous moneylenders push fast cash onto often desperate victims. Various predatory lending schemes include check cashing, payday loans, subprime mortgages, rent to own, refund application loans, car title loans, pawn shop loans, and a host of other high interest loans under the guise of deceptive marketing practices. The common thread between loans considered predatory includes a mix of high interest rates, some over 500%, high fees, a prepayment penalty, or a fee for borrowers that pay off a loan before its due date, faulty underwriting, and a general misrepresentation of the terms of a loan. While some consumer protections are in place, these fringe financial institutions often circumvent regulation and continue to disproportionately target single women, people of color, young people, and the less educated. The cycle of predatory lending and debt often forces unsuspecting borrowers into a vicious cycle of repayments, additional loans, and a debt of far more than they originally borrowed. Predatory lending is an immoral, unethical, and exploitative practice that perpetuates poverty and inequality and allows the lenders to profit off of vulnerable populations. One major issue with regulating predatory lending is the ambiguity within the definition itself. While some argue for a loan interest minimum to determine if a loan is predatory, the practice is often a combination of high interest as well as exploitative contracts and aggressive salesmen that understate the penalties associated with the loan. Common features of predatory lending includes cost beyond reasonable risk-based pricing, which is the accepted method for lenders to charge a higher interest or refuse a loan directly related to the borrower's credit. What is and what is not reasonable in risk-based pricing creates a gray area, but for the sake of ameliorating the negative effects of predatory lending, it can be defined as any financial transaction with an intentional exploitative mechanism involved in the procurement, contracting, and completion of a loan. Payday lending storefronts and promises of quick and easy cash have become a staple of low-end strip malls in America, outnumbering even McDonald's restaurants. It's estimated that 5% of the U.S. has taken out a payday loan, a number which seems shocking when considering how explicitly dangerous these loans could be. Even if borrowers know the potential consequences associated with the loans, those lacking credit often do not have access to the consumer protections associated with mainstream financial institutions. Many who have fallen victim to predatory lending cite emergencies that force them to look for fast cash, medical emergencies, urgent home repairs, or even groceries. Lack of access to a bank leads to lack of savings, which in turn turns small, necessary expenditures into catalysts for monumental debt. While waves of unemployment during the COVID crisis sent people into financial straits, payday lending companies have boomed by offering their services to those waiting on unemployment checks, stimulus plans, and COVID relief. When the American economy suffered from stagnation and a global pandemic, fringe financial institutions acted like vultures, turning others' crises into profit. With the negative effects of predatory lending so explicit, it's difficult to believe that there is a market of consumers willing to sign on. However, there are over 160 million Americans with bad credit scores, and these lenders are filling a gap in the market to serve those excluded from traditional financial institutions. Additionally, those without a U.S. ID cannot open a bank account, and others are excluded from opening bank accounts through minimum balances, opening fees, or high overdraft fees, leaving 20% of Americans without a bank account. While historically marginalized groups have previously dealt with barriers to receiving credit, present-day concerns should move focus from access to credit to terms of credit. Many borrowers are unaware of their alternatives, if there are any, and if they lack financial literacy, are susceptible to concealed essential information, misrepresented loan terms, and unfair and aggressive tactics to collect payments that are common in the industry. When the borrower is cornered into limited fringe financial options, predatory lenders exploit their desperation and render borrowers unable to self-advocate with aggressive marketing, collecting, and contracting practices. Consequences of predatory lending severely limit economic mobility, thus ensuring the death of the American dream for borrowers. Defenders of payday lending often cite the demand for quick cash as legitimization for their businesses, but their model borrower is severely misrepresented. While it is ostensibly possible for borrowers to take out a payday loan, repay it promptly, and not borrow again within the year, This is only true of 1% of borrowers. More often, borrowers fall victim to exactly the kind of debt cycle that the lenders set up and are forced to make payments long past the original term of the loan. The issue is so pervasive, in fact, that nearly half of every low-income people living under $15,000 a year spend greater than 40% of their income on servicing non-mortgage consumer debt. Total costs of borrowing amount to $25 billion annually, affecting over 5 million American families each year. Predatory loans turn short-term financial emergencies into long-term problems that severely limit any upward economic mobility by continually collecting interest. Discrimination is a key player in the exploitative business of predatory lending. Often, lenders are encouraged to go after single women, people of color, the elderly, and less educated individuals. The placement of these storefronts is intentional as well. In Michigan, areas that are more than a quarter Black and Latino have 7.6 Payday stores for every 100,000 people, or about 50% more than elsewhere. Another study found that African American neighborhoods have 3 times as many Payday stores per capita as white neighborhoods. While there could be some discrepancies between the correlation and causation of these locations, as well as the relationship between predatory lending and the racial wealth gap, it's clear that due to the placement and targeted marketing of predatory lending, these institutions serve to perpetuate economic and racial inequality. Ethically, predatory lending is a reprehensible injustice, but since it is such a lucrative business, profit often clouds the judgment of legislators and lawmakers. The issue perpetuates inequality and poverty through deceit and exploitation, breaking the first of Peter Singer's principles of ethics, the duty of non-maleficence. In many cases, issues that perpetuate poverty and inequality are the result of good intentions poorly executed, but predatory lending is the result of bad intentions. According to Singer, people have the primary duty to do no harm and tend to surpass this with a beneficence-oriented set of ethics, or a propensity to do good. Through another ethical framework, John Rawls states that our actions should aim to make those in the minimum position maximally well off. Predatory lending seeks to do the opposite, specifically and relentlessly targeting the vulnerable and attempts to distribute wealth away from the poor and into their pockets. In both the case of Singer and Rawls' ideas, predatory lending does not just diverge from their theories of moral responsibility, but it acts as the direct opposite of what the philosophers describe. While such a large, pervasive problem is difficult to tackle, many communities are already addressing predatory lending through increased access to alternatives, structural changes, and community education. Education and financial literacy about informed borrowing can help borrowers advocate for themselves, avoid financial traps, and reduce accumulation of debt. Structural changes to financial institutions, like lowering the account fees and marketing available services, can steer individuals to more protected traditional financial institutions for borrowing, saving, and wealth management. If traditional banking is not an option due to low credit or simply location, community development financial institutions are a promising community-based solution for predatory lending. These institutions measure success through financial performance as well as community development impact, making them a viable solution to communities plagued by debt and the effects of predatory lending. At a policy level, state and federal legislation should work together to increase consumer protections from predatory lending and ensure that these companies cannot exploit loopholes to continue business as usual. When considering the causes and consequences of poverty and inequality, predatory lending acts to enable the wealthy to benefit from the exploitation of the poor. The lending practices aim to exploit those suffering the harmful effects of poverty and use their vulnerability to trap borrowers into becoming slowly robbed of any equity or financial freedom they might have enjoyed. Current lending practices must be addressed in order to stop the disproportionate and relentless financial suffering of the poor, and it is our moral responsibility to do so.